Jamaica's credit card debt climbs above $94 billion as borrowers face rates of up to 52%. Outstanding credit card balances in Jamaica's commercial banking system increased by more than $3 billion in just 4 months, raising questions about whether more households are relying on some of the most expensive credit available to manage everyday expenses. Bank of Jamaica data indicate that credit card receivables rose by approximately 3.5% between December 2025 and April 2026, reaching roughly $94 billion. That represents an increase of about $3.2 billion from an estimated $90.8 billion at the end of December. The expansion occurred despite Jamaican-dollar credit cards carrying annual interest rates ranging from approximately 37 to 52%. These rates are several times higher than the Bank of Jamaica's policy rate, which stood at 5.5% in April 2026, after being reduced from 5.75% earlier in the year. The central question is whether the increase reflects a greater consumer confidence and spending, or growing financial pressure among households using revolving credit to bridge gaps in their monthly income. The increase was concentrated almost entirely in Jamaican-dollar accounts. Outstanding Jamaican-dollar credit card balances reportedly climbed by 5% to approximately $86.5 billion. This suggests that the balance was around $82.4 billion 4 months earlier, an increase of approximately $4.1 billion. By contrast, outstanding debt on United States dollar-denominated cards fell by 2.4% to the Jamaican dollar equivalent of approximately $8.2 billion. The diverging movement is significant. It suggests that the overall increase was not simply the result of increased overseas purchases or foreign currency borrowing. Domestic currency credit card activity appears to have been the principal driver. The figures supplied, however, contain a small discrepancy that requires clarification. Jamaican dollar balances of $86.5 billion and US dollar balances equivalent to $8.2 billion add up to $94.7 billion, not exactly $94 billion. This could be the result of rounding, exchange rate conversion, or the use of slightly different reporting periods, but the detailed Bank of Jamaica tables would be needed to reconcile the difference. Credit card receivables represent balances owed to the banks. They do not necessarily mean that every dollar is overdue or attracting interest. Customers who settle their statements in full during the interest-free period may avoid finance charges. The risk is concentrated among customers who carry balances from 1 month to the next. At the prevailing Jamaican dollar rates, a cardholder maintaining a $100,000 balance for a year could face approximately annual interest rate of 37% or $37,000, 45% or $45,000, 52% or $52,000. Simplified calculation before payments, fees, and compounding. Actual charges depend on the bank's calculation method, transactions, and repayments. At 52% annually, the simple monthly equivalent is approximately 4.33%. A borrower carrying $300,000 could therefore incur roughly $13,000 in interest during a single month before fees and new purchases, depending on the card agreement. Across the $86.5 billion portfolio, the theoretical annual interest exposure would be between $32 billion and $45 billion if the entire balance attracted the interest for a full year. That is not an estimate of what banks will actually collect. Many accounts are paid in full, balance changes monthly, and customers are charged at different rates. It nevertheless demonstrates the potential scale of the borrowing cost. The Bank of Jamaica figures measure the amount owed, but they do not explain why consumers accumulated it. Several possible factors require investigation. One explanation is increased consumer spending. More people may be using cards for convenience, online purchases, travel, subscriptions, and routine household transactions while settling their statements on time. A less reassuring possibility is that some households are using credit cards to supplement income and meet the cost of food, utilities, transportation, school expenses, or medical bills. Another possible contributor is the accumulation of interest itself. When a customer makes only a small or minimum payment, part of that payment goes towards finance charges rather than substantially reducing the principal. New interest is then calculated against the remaining balance. This can create a revolving debt cycle in which the borrower continues making payments but sees the outstanding balance decline slowly or even increase after new transactions and fees. None of these explanations can be confirmed solely from the aggregate balance. A proper assessment requires data showing how much of the 94 billion is paid in full monthly, how much is revolving, and how much is delinquent. The movement in credit card rates also highlights a broader issue in Jamaica's banking system. Reductions in the central bank's policy rate do not necessarily produce equally rapid reductions in consumer lending rates. In March 2026, the Bank of Jamaica's Financial Policy Committee reported that deposit rates had declined in line with monetary policy easing, while lending rates remained relatively unchanged. The committee attributed the pattern to what is called structural rigidities in credit pricing. This means savers may receive lower returns on deposits while borrowers continue paying comparatively high rates on loans and credit cards. Commercial banks would argue that credit card pricing cannot be directly compared with the policy rate. Card balances are unsecured, meaning the bank generally has no house, motor vehicle, or other pledged asset to recover it if the borrower defaults. Rates also reflect operating costs, fraud risk, expected credit losses, and the convenience of having a reusable credit facility. Nevertheless, a maximum annual rate of 52% raises legitimate questions about competition, pricing transparency, and whether the rates are proportionate to the actual risk and costs borne by financial institutions. The Bank of Jamaica publishes commercial bank rates information compiled from reports submitted by the institutions. The 2.4% reduction in US dollar denominated balances provides an important counterpoint. Rates on foreign currency cards reportedly range from approximately 17 to 22% annually, considerably lower than those charged on Jamaican dollar cards. However, US dollar borrowing carries an additional exchange rate risk for consumers who earn primarily in Jamaican dollars. If the Jamaican dollar depreciates, borrowers may need more local currency to repay the same US dollar balance. The reported $8.2 billion figure is also a local currency conversion, meaning movements in the exchange rate can affect its reported value even if the underlying US dollar balance changes by a different percentage. The decline could indicate reduced foreign currency spending, tighter limits, increased repayments, or consumers' efforts to avoid exchange rate exposure. The aggregate numbers do not establish which explanation is correct. The 94 billion headline is significant, but it is not enough to declare that Jamaica is facing a credit card default crisis. Credit card receivables include accounts that are being managed responsibly. A higher outstanding balance can result from more cards being issued, higher transaction volumes, or temporary balances that customers subsequently pay in full. To determine whether the increase represents financial distress, regulators and banks should disclose the number of active credit cards accounts, the average balance per card holder, the proportion of customers paying their full statement balance, the share making only the minimum payment, the value of balances that are 30, 60, and 90 days overdue, the amount classified as non-performing, credit card write-offs and restructurings, the distribution of balances by income group, banks' total interest and fee income from credit cards, whether lending rates have declined following reductions in the policy rate. Without those figures, the public can see the size of the debt, but not the condition of the borrowers carrying it. The increase warrants direct answers from Jamaica's commercial banks and the Bank of Jamaica. Banks should explain whether the growth resulted from new customers, higher spending by existing customers, or the accumulation of unpaid balances and interest. They should also disclose whether delinquency and minimum payment rates have risen since December 2025. Regulators should clarify whether they have detected any deterioration in household credit quality, whether affordability assessments remain adequate, and whether customers are being given sufficiently clear illustrations of the long-term cost of making only minimum payments. Another issue is whether the market is sufficiently competitive. If several institutions maintain similarly high credit card rates, even as monetary policy eases, consumers need to know what prevents borrowing costs from falling more quickly. Jamaica's rising credit card balance is an early warning indicator, not proof of a crisis, but a trend that deserves closer scrutiny. The confirmed picture is that commercial bank credit card receivables increased by approximately $3.2 billion in 4 months, driven by a sharp rise in Jamaican dollar balances carrying rates as high as 52%. What remains unknown is more important. How much of the debt is being paid off every month, how much is revolving at high interest, and how many borrowers are falling behind. Until banks and regulators publish that information, Jamaicans will know how much is owed, but not whether the 94 billion balance represents healthy consumer activity or a growing household debt problem hidden behind minimum monthly payments. Subscribe today, turn on notifications, and never miss the stories that matter most. Jamaica News Now, your Highlands, your news, right now.